At Know Your Numbers Accounting, we believe in providing free small business education. But if you want to pay us for it, I guess that's okay too. Today we'll be talking about the debt-to-equity ratio. The debt-to-equity ratio is another leverage ratio that takes two important numbers from the balance sheet and divides to conquer. Well, divides to conquer ignorance of financial risk. We don't just divide willy-nilly around these parts, we respect the law. Accounting law. Your debt-to-equity formula looks like this. Debt-to-equity ratio equals total debt divided by total equity. Both amounts are easily located on your balance sheet, which, despite its name, is not a magical bedsheet that somehow stays evenly distributed between you and your spouse. Now that's a money-making idea. The debt-to-equity ratio helps you measure the degree of debt financing compared to equity, or owner financing. Because debt is on the top and equity on the bottom, a ratio that comes out to higher than 1 will indicate a greater percentage of debt financing, and a number lower than 1 indicates a greater percentage of equity financing. If it's exactly 1, then your debt and equity are like two little fat toddlers who can't get the teeter-totter to work. They're perfectly balanced. For an example, let's say you start a company that sells this miraculous theoretical bed sheet that always lays evenly across a bed. On your balance sheet, you have $50,000 of debt and $25,000 of equity. This leaves you with a debt-to-equity ratio of 2, indicating you have twice as much debt financing as equity. On the other hand, if you only have $10,000 in debt and $50,000 in equity, you'll have a debt-to-equity ratio of 0.2, or well below 1. In this case, you have 5 times as much equity funding as debt. The debt-to-equity ratio tells you quite a few helpful things. If someone invents a pill that magically allows people to never sleep again, your nifty sheet business might suffer. The debt-to-equity ratio can help inform you whether or not your equity can cover debts, in the case of a regrettable pharmaceutical emergency like this. A lower debt-to-equity ratio will also look more attractive to lenders, as it indicates a more conservative business model. A high debt-to-equity ratio is often associated with higher risk ventures, because it means that a company has been quite aggressive in financing its growth with debt. But high leverage ratios aren't necessarily risky if you're in a slow growth industry with stable income. It really depends on what a standard ratio looks like in your particular field. In the worst case, a company may have negative equity, and therefore a negative debt-to-equity ratio. This is a big red flag. Your sheets may be up Sheets Creek. If you need help analyzing your paper balance sheet, contact Know Your Numbers Accounting today for quick, accurate analysis. All well within accounting law.